Hi everyone, and welcome to Philanthropy Impact Walk in My Shoes series for professional advisors, where today our panel of experts will be focused on maximising ESG and impact investment clients' satisfaction, addressing suitability issues. My name is Zofia Sahanek, and I'm the Director of Membership and Development at Philanthropy Impact and also the moderator for this series. Our Walk in My Shoes series is carefully curated to bring you concise but informative sessions to help you navigate the philanthropy and impact investment space with your clients. This is part of our core mission to increase and improve philanthropy and social investment and to also encourage impact investing. If you'd like to know more about our other services and the benefit of membership for you and your firm, then please do get in touch with me. My email will be in the chat or at the end of this recording for those watching on YouTube. As this is a strictly 30-minute session, it will go very quickly, but we do try to encourage our audience to interact. So please use the chat to introduce yourselves, have your say, and pose questions to our panel. Please make sure to select panel and all attendees when posting in the chat so that everyone can see. It is now time to introduce our chair for today, our board member, Jamie Broderick. He's formerly head of UBS Wealth Management. Jamie is now a director at the Impact Investment Institute. And joining Jamie, we welcome Amy Clarke, who's the co-founder and chief impact officer at Tribe Impact Capital, Keith MacDonald, partner at EY, and our very own CEO, John Pepin. Thank you all so much for your insight today, and I'll now hand over to John to make a start. Oh, sorry, Jamie. Jamie's making a start today.
I'd like to start. Thank you, Zofia, and welcome everybody. And thank you to Amy, Keith, and John for joining us today in this discussion. The clients of wealth advisors are increasingly aware of sustainability issues, and they're more interested than ever before in having those issues incorporated in their investment strategies. So when an advisor has a conversation with a client about their goals, motivations, and values, those sustainability preferences emerge and then necessarily become central to determining what is a suitable investment for that client. So the suitability question is no longer just a matter of financial circumstances and the ability to bear risk. So what I'd like to explore with you today is whether wealth advisors are equipped to have those conversations with their clients to find out their sustainability preferences, and are they prepared for potential changes by the FCA in what constitutes an effective suitability assessment, potentially moving closer to equivalency with what the EU is doing with its MiFID II requirements. So Keith, let me start with you. Let me ask you what you are seeing in the wealth advisory marketplace in the suitability discussions. Are they going up beyond a client's financial situation and their ability to bear risk? What are you seeing these days?
It is very mixed. I mean, we're seeing this sort of globally, regionally, as well as UK, and yeah, between the bank-owned and the independent wealth managers, private banks. I mean, there's a real mixture in terms of how high up the agenda it is, how much it's reach in the front office, and so ultimately how much it's reach in discussions with clients. I mean, clearly, suitability post MiFID is a regime that people are trying desperately to follow. This brings in an extra layer of complexity with the discussion, where it's not just about risk appetite and other regulatory factors, but about values and principles. And I think one of the biggest issues is definitions of those between social development goals, what does sustainability mean, ESG itself, all the sub-measures of ESG, and then critically, I think the fact that the data doesn't exist to support a lot of those definitions and then benchmarks yet. So this to me feels like it's the start of quite a long process, and some of the work we're doing with wealth managers particularly, they're deliberately keeping this as a sort of 2 to 3 year program, not trying to crowbar it into business as usual straight away. So I think several things. That one is it's mixed, 2 is it's early days, 3, I think it's still a bit sort of supply push, you see what I mean, rather than really getting the conversation going with clients and bringing both clients up to speed and, to be frank, front office up to speed about what all these different moving parts mean and how they fit together.
And when you say it's between bank-owned and independent, what is the difference there?
Well, I think like lots of these topics, the big universal banks, a lot of these debates are going on at group level. There can be international aspects of that depending on where the home country is. And each of them has got a very different business unit structure for where wealth management sits, onshore, offshore, where private banking is, definitions of high net worth and affluence. Some are credit and banking-led relationships other than investment-led relationships. So it's very difficult to compare like with like in the big universal banks and how that cascades down through to the client-facing pieces in this market. I think there is more clarity amongst independent wealth managers, but even there it depends on what type of model. Is it a sort of partnership franchise versus full employee support to the clients? And therefore how directly can messages be put out to clients on all these topics, really?
Yeah, well, let's ask one of those independent wealth managers. Amy, Tribe just recently won the award for most innovative wealth management at the Wealth Briefing European Awards. So that tells me that you're doing you're doing things at the innovative end of sustainable wealth management. So tell us a little bit about what the cutting edge looks like, sustainable investment.
Thanks, Jamie, and thank you very much for just flagging as well. That was very kind of you. It's really, really interesting because it doesn't, and I say this with a huge degree of humility. I honestly don't think it takes too much to be that innovative in wealth management. As I said, I say that with a huge amount of humility here as well. Partly because I think the model that has been in place in wealth management has been as it has been for decades, absolutely decades. And the fundamental missing piece in that client relationship is actually how well you understand your clients. And this is where we sort of decided right from the word go with Tribe, with the client relationship side of the business. In order to be really effective as a partner with somebody on their wealth management journey, we needed to really understand who they were, what they cared about, why they cared about it, and then to be able to help them through, obviously, in many ways, the counselling that we provide and the support that we provide, help them exercise those values and beliefs in their wealth management strategy. Now, that to us is just part and parcel of a good client management strategy. It's about understanding your client and retaining your client. Put alongside that, the absolutely critical nature of the risks that we are facing. Now, those risks are no different to the risks that we were facing 10 years ago, 20 years ago, 50 years ago. What has happened now is something called dynamic materiality. The markets have now started to recognize that climate risk, access to food, access to water, access to a roof over your head, access to education, these are the things that actually define and dictate how successful our economic growth will be. And as a result, they've become critical to business success. Now, those two worlds intersect beautifully because having access to food, providing education for children, tackling climate change, these are what clients care about. These are what we as humans care about. We want to live in a healthy, thriving society where everyone and everything can thrive. And if we know that our capital is not creating those conditions, then we're likely to be very, very concerned about what it is creating. So when we set up Tribe right from the word go, we recognized that we needed to do two things: recode what risk actually was, and then rebrand that as an opportunity. So take the risks that are out there, climate change, all the externalities that the market refers to them as, and say, well, actually, these are the very things that define how successful we will be. So let's invest in them. Let's invest to tackle them. And secondly, let's encourage our clients to exercise their values and their belief systems in their wealth. Let's create a destination where people can come and genuinely talk about the things that they care about and know that there is a space in finance for them to take action on that. And it's a space that is beyond philanthropy. Philanthropy is one part of it, but there's a space beyond that, which is investment. So we created this model, which Jamie, because you've very kindly been through it with us. We created a model called the Impact DNA process, which we took to the FCA back in 2016 to say, this is how we are going to profile our clients. It recognizes all of the regulatory risk requirements that we have to, but also helps them articulate how they feel about these externalities and the issues that they want to take into account that mirror their values, but we know from a risk point of view actually should lead to a level of hopefully outperformance in their portfolios, because we'll be investing in the businesses of today and tomorrow. So it's that wonderful sweet spot. And the Impact DNA process allows us to do that. And we've been doing it since 2016. And the one thing that I would say is it's really not rocket science. There's plenty of education out there now, I think, in the marketplace. John will talk about the work that he's doing. We've got others, we've got CFA, CISI all moving into this space. My question is it, and partly riffing off what Keith said, is it a question of there not being enough education, or is it more of a question of a lack of intent?
That's a very interesting question. Maybe John has an answer to that. But so John, what do you think needs to happen? So we've got this gap here. Where do you think it needs to go? I mean, is it a question of training, and what are people telling you about their interest in training? Is there demand for training?
I think the intent versus education is really a good point. Thank you, Keith and Amy, for making my point for the rationale for our training. That's brilliant. Thank you. The intent certainly is there from a client perspective. I mean, all the feedback we're getting from talking to trade associations and a lot of fund managers, etc. The education is lacking. And it seems to be a real issue. The other is FCA taking its time to do equivalency with MiFID II. And so we're trying to work on that with other organizations to try to get clarity. So there's a need to prepare for that. So it's just not client trend, it's both that and stuff. If we were to look at data, the trend towards ESG investing is just going sky high like that over the next few years. Clients want more. And interesting, talking to some millennials and women of wealth, it's very clear that they want the whole way of dealing with this whole area of environmental, etc., to change. And so in some cases they're firing their advisors because they just don't have any understanding of what impact investing is. So what we're doing in the training is we're focusing on client relationships and how to discuss with clients their values, their motivations, their ambitions, how to turn that into goals through SDGs, because they haven't been mentioned here yet, and then ESG, and then to product. And one of the issues is that in many of the firms, the products aren't there for all SDGs. And so it's going to be complicated, and we talk about how to manage those discussions. We talk about market trends, terminology, because there are so many different words and definitions. We talk about how to structure this suitability discussion beyond just what the FCA regs are, and how this really benefits the business, because it's good for business. As was mentioned earlier, you retain clients, but you also help to get new clients.
Can I ask you, John, do you think the FCA, you said the FCA is dragging its feet and getting ready for this. Is it actually going to happen, or is it one of those things that post-Brexit, we're thrilled that we don't have another piece of regulation on this? I mean, do you think the FCA is going to do something that looks like MiFID II, which will require advisors to inquire about sustainability preferences?
A lot of the people in the sector have been giving me clear indication that they think it's going to happen, but not tomorrow. But it's looking at the next couple of years. Part of the issue is it's being discussed within Treasury, and that will drive it to a certain extent. So it seems that it'll happen, but it's still not an issue. And I don't think that's the sole reason for people to be trained up and to take the approach that Amy's talking about, because clients want this, and there's a trend towards this. Young people, women of wealth, they're focused on societal issues, on environmental issues, and it's key to their investment decisions. And if you don't have product, you don't have the ability to discuss it with them, then I think as a wealth advisor, you're going to lose clients.
It does seem odd that we're interested in having the FCA teach us how to be better wealth managers. That's not a great situation to be in, where we don't spontaneously come to this. I want to ask Keith, you already struck this theme of that it's taking a long time. It's going to be several years. You said a 2 to 3 year program, but the MiFID II has already kicked in. The whole sustainability, the sustainability and suitability requirement is already kicked in Europe, isn't that right? And so how how is it that people feel comfortable taking 2 to 3 years, or is that just in the UK?
Well, I think some of it is the early emphasis is trying to tick the boxes of those regulatory requirements rather than necessarily what they're there for.
Yeah.
I think, the regulators would always say that they've put regulation in place to try to encourage the industry to do what it should be doing anyway. But I think particularly because of some of the post-Brexit differences in attitude between FCA and EU, I think it will take time to settle down into the pattern that particularly cross-border firms can sort out internally, particularly back to my point before about data not being there to support those decisions.
Yeah.
I find sorry.
Go ahead, John.
I just find it intriguing that in our research to develop the training course, we talked to a number of compliance people who are definitely preparing for this. So there's pressure coming from different parts of their organizations.
I think there has been an expectation that the UK wants to be ahead of the game on this, not behind the game. And COP26 and everything that's going on at the moment in terms of G7 and the discussions, I think the aspiration from a UK perspective is to be front foot. So you would hope that the FCA would encourage that.
Yeah.
Jamie, can I just add on something that John said, because I think he's just made a really, really valuable point. Regulation is only ever there to raise all boats up to a lower common denominator, not necessarily the lowest, but to a lower common denominator. Innovation is what creates the blue water between you and everybody else. And that's exactly what John was just talking about. Regulation's only ever going to take us so far. Innovation is what drives you forward and what gives you that competitive advantage and that competitive edge. So to a certain degree, regardless of what the FCA decide in this space, given what John's spoken about in terms of shifting consumer sentiment, given what I've spoken about in terms of rising levels of externalities being unaddressed in investment portfolios, climate risk being a phenomenal example of how you can get it fundamentally wrong, why would you not be engaging your clients on this?
Well, that's a very good question, Amy, and it's sort of, you made a very, very interesting comment earlier, which is that it doesn't take much to be innovative in the wealth management business, because it feels like people are, I mean, you talked about innovation, but it was innovation that consisted of listening to your clients, talking to them, figuring out what they actually want, probing deeply, which that's innovation, okay. Yes, that you can put some blue water between you and other people by doing some of the things that, I mean, it's just fascinating that we're talking about doing things that we should be doing anyway, doing things that are really, really good for business, doing things that clients love and that deepen their relationship. And yet we still have to have a little bit of a nudge from a regulator. And I just think that's fascinating. Now, John said that we haven't talked about the SDGs. So I wanted to come back to you, Amy, and just talk a little bit, can you be a little bit more specific about how you pick out the role the SDGs play in your process and how you identify what clients care about and then what you do with that information? Because that's sort of the question. It's not enough to just ask people what you want. It's also then what do you do with that? What's your...
Yeah, I mean, it's interesting. I think an awful lot of what's going on in the market at the moment is asking people what they don't want. And it's a little bit like going to a dietitian and the dietitian saying, okay, this is what you shouldn't eat. Well, actually what you want to know is what should I be eating as opposed to what should I be avoiding. The SDGs, the Sustainable Development Goal Framework, that we have pretty much codified into the essence of everything that we do as a business, is the first time since 1984 that we've had a really clear definition of what sustainable development needs to look like and what the parameters are, those guardrails that need to be put in place to create this safe space where everyone, and really importantly, everything can thrive. Now, I use the word thrive rather than grow, because within that is an entirely different conversation. But that's what the SDGs do. Now, yes, they are predominantly a governmental framework for public policy. But as investors, we're constantly looking for that crystal ball in terms of where is public policy likely to go? Where are there going to be great investment opportunities for today and tomorrow? And when you have a universally adopted framework that creates those and sets in place those guardrails for society, it also then does the same for business by default. So it gives us a really good idea to say, okay, well, the businesses that are operating within those guardrails, and also not just operating within them, but they're also trying to restore and repair the damage that's been done. These are the businesses that are, we believe, are the businesses of today and tomorrow. These are future fit. These are the companies that should perform. But also those guardrails that have been set are based on a common set of values, things that we believe in as a human race, that are universal. Things, for example, well, I say universal, equality. I'd love to think that people believe in equality universally. I'm not sure everybody does, but these are values that people hold dearly, kind of, in a global context. So we have created this process that enables our clients to work their way through the SDGs and to express themselves through the lens of that Sustainable Development Goal frame. The goals that are obviously comprise the framework, as well as the targets and the metrics and the behaviours that need to sort of surround the goals to make them, to embed them into society, but also to make them successful. And it's part conversation, part game. There's a gamified element to what we've done to really bring it to life for our clients. And from that, we're able to tease out effectively a theory of change from them that's also embedded in the type of impact they're looking for as well. So different facets of impact, macro, micro, local, global. We're able to extract all this information from them in a really fun, non-threatening environment, and then play that back to them to say, these are your values, these are your beliefs, this is what you're aiming to achieve in the world, this is the living legacy that you want to create with your wealth now, not when you die, now. And therefore, we've been able to translate that into a portfolio that does that for you. These are the types of businesses and opportunities that deliver that for you. And we play it back to the clients. Now, it sounds very simple. Obviously, there's a lot of kind of complexity that sits behind that. But it's the art of using technology, I think, and then the collision of behavioral finance, sustainability and financial risk into a sort of I suppose, a questionnaire type conversation that really helps our clients express who they are and what they want to create. And then for us to then say, here are your parameters. This is what your portfolio is going to look like.
Well, Amy, you've thought this through very carefully. And as you mentioned, I've been through the Impact DNA process, and it is exactly as engaging as you say. So, but I'm going to ask Keith. Okay, so here's the leading edge. The Tribe Capital has comfort with this kind of thing, but it is considered innovative and different. Keith, what are you seeing in the rest of the population? Are people able to? It's one thing to ask people what SDGs do you care about. It's another thing entirely to translate that into a product or service proposal. I think that seems quite complex to me. And then I also wanted to ask you if as you look at the landscape and look at the managers, have we put to bed the question of whether investments that generate social and environmental value can also generate appropriate financial returns? Are clients still asking about that? Have we put that to bed? Sorry to load so much on you, but that's sort of where I'd like to kick it off.
In 2 minutes, yeah. And I'll try to pick up this interesting question in the chat as well about, quite a specific cause, something like animal welfare. And I think the hardest thing that's going to come out of this in the short to medium term is how, if you're having a discussion with a client and you're balancing the 17 sub-measures of E, S, and G, never mind SDGs, specific causes that people have personal beliefs in, and then you're putting that alongside suitability and risk appetite and that whole regulatory requirements as well. It's very difficult because A, the data isn't, as I said before, the data isn't there to differentiate between a lot of these types of investment. And B, if you start ticking too many boxes, you shrink your list of what you can invest in very, very quickly to a point where it doesn't make any sense at all. So that's Amy's situation. That's why I think this idea of creating a portfolio that's representing what people want. And you're seeing this in some of the startup app-based firms coming through with their propositions, particularly for the millennial segment. An attempt to simplify it to a point where it's viable in the short term, where it's not actually, is it innovative? It's something which can represent what people hopefully will be able to do in 5 and 10 years' time, but when actually the infrastructure and the data doesn't really exist yet to do it.
And
Is that innovation, or is that just creating something that's on a way towards a destination? I'm not sure.
And Keith, before you go to that question in the chat, I want to ask you, so what have we put to bed the question of financial performance? I mean,
sorry, on returns. Well, I mean, there's still detractors from that, but I think the general belief is yes. And actually, if you see, I think one of the upsides of the last sort of 15, 16 months is purpose, corporate purpose has come absolutely to the top of every discussion at every level. And you see it in TV advertising, you see it in sponsorship. And so I think the issue around return versus purpose and social goal, it's not become a non-issue, but it's certainly not something that's I've heard much about recently in terms of people questioning it.
John, are you finding the same thing when you talk to people, when you do your training, when you talk to people, are you finding that that was yesterday's problem and now we've moved past that, or is it still a struggle?
No, it's not coming up at all. The real issue is how do you meet client needs and build relationships with clients. The other part of it, though, I think Keith was getting at, is that there's not the product there in many firms. You just don't have the product for the clients to invest in, and there's issues around. I think that we try to cover that in the training. The tool that Amy's using, we have a version of that in the training. It's really quite fascinating to take people through that whole process. It's a brilliant tool. But in many cases, it would be difficult because most of the firms won't have the product to do all that. And
voila, yeah, absolutely. Yeah, very interesting problem. Keith, I want to come back to you because since you volunteered to take on the question in the chat, which is basically how do you, well, this question from Jessica Maybanks is really how do you the FCA to be influenced in terms of looking at the breadth of ESG considerations within the regulation, and in particular, animal welfare. So you volunteered to take that on. Go ahead.
Yeah, and I suppose I was thinking of that as an example of loads of different types of cause that it's actually quite difficult to fit it into the definitions. It's interesting. I think it was the Dr. Martin's press recently. They're going to try and push more, away from leather goods and things like that. So good case studies like that in the press will help. But fitting a particular cause into even ES and G, never mind social, and then how you measure a particular corporate, you might have a brilliantly governed company that is actually doing things which are not good from an E or an S perspective. So how you balance different parts of the measures and the data to support that. There's no simple way of doing that, I don't think.
I'm going to ask each of you to make a final word of wisdom, leave us with a final word of wisdom. But before I do that, I'm going to ask Amy how you would handle it if a client said, I really want to focus on animal welfare. How would you deal with that? But I want to come back to all of you for the final word of wisdom.
Yeah, we have clients who come to us with that. We've had clients who've come with very specific requirements geographically as well, saying I really want to either invest in this geography or I want to avoid that geography. And I think what you're doing is there is data out there. The problem is actually sometimes there's too much data, not too little. It's the quality of the data that's the problem. And this is where you have to effort. You have to work hard to understand how to then create a portfolio. And I think in what is fast becoming a predominantly passive investment world, that doesn't sit comfortably with a lot of individuals having to work. On the animal welfare, there's a fantastic initiative by Jeremy Collar, the FAIR Initiative, which is all around animal welfare and more broadly sort of the protein revolution that's going on as well. So we've had a client come to us saying, I don't want any animal testing, but also I actually want to then specifically find those companies who are really at the kind of the bleeding edge of animal welfare. You have to understand what constitutes animal welfare, what the risks are, the downsides, what the upsides are, the opportunities, and build that into a theory of change in a portfolio. And Jamie, you know this because I've said this 1,000 times before, that means you have to work.
Okay, so I'm going to pause you there because I need to hear a final word of wisdom from John Pepin.
Oh, I get the opportunity to actually say this session could go on for another 3 or 4 minutes, so that's great. Okay, a couple of things. One is recently I saw a very, very clever use of SDGs. There was a campaign that someone was putting on for something that is really politically fraught with issues but legitimate. And they used all 17 SDGs as a rationale for people to support their campaign. It was really brilliant. I've never seen that. It's very clever. Okay, final words. Clients want this. We have to change the behavior and culture of the wealth and the other advisory marketplace as well. And because lawyers have to pick up on this, etc. Building client relationships, as Amy has said, is absolutely key. And basically, we want to control the kind of society that we want to build. And go to our website and look at the latest magazine, which is all around SDGs. Thank you.
Fantastic. Very wise. And Amy, wisdom. Short wisdom.
Short wisdoms. Oh, crikey. Don't wait for regulation. If you wait for the regulation, you're always going to be 1 foot off the pace. This is the right thing to do. It makes sense from a commercial point of view, an ethical point of view, a client retention point of view, you name it. It's a tick, tick, tick across the whole smorgasbord. So get that competitive advantage coded into your business now. Don't wait for regulation.
That's great. That's great advice. And Keith, we haven't used up all the wisdom, so what do you have to suggest?
Very, very short, Charles. How can you follow those two? No, I think, in the same way, corporate, this has got to come from the top of the wealth managers as well. Otherwise, it's going to be, it won't connect. So, this is about the brand of this industry and this industry putting something back as well. So from board all the way down, it needs to be consistent. So, if people are in an organization where that doesn't seem to be happening, I would challenge upwards and make sure this is really being done for the right reasons, not as your point, to make money out of it, which would be the worst situation. So, but back to my first point, I think this is the start of a long process and a long education process, to tee you up for nodding in again, John. That it's going to take quite a long time for people to understand how this works and how it works from a societal perspective, never mind an investment perspective, I think.
That's great. Listen, I think this format, trying to get a webinar together over 30 minutes is a little bit crazy, but we have packed so much insight into this 30 minutes. I just want to say thank you to John and Amy and Keith. Thank you very much for this. This has been a fantastic discussion. In half an hour, we are all so much wiser. And with that, I'm going to return the mic back to Sophia.
Oh, no, just before you do, sorry. Okay. We always ask the question, final words of wisdom from everyone, including the chair.
I was about to say that.
Okay. Well, the wisdom's all used up. I used to run a wealth business. I used to be in charge of UBS Wealth Management in the UK. And I have to say that it puzzles me, because I think this approach to the client relationship is good business. It deepens the client relationship. And I can't for the life of me figure out why people aren't running to be integrating suitability, sustainability into the suitability discussion, because I think it is extraordinarily powerful for any wealth advisor's business. And you've seen there's an open field here, you should rush in. And that's how I close. Back to Sophia.
Thank you, Jamie. That was brilliant. Really well done. We have had a comment in the chat that I thought I'd just bring up, where a lawyer has agreed that lawyers have a big part to play in this as well, as we don't have one representing today. I just thought I'd read that out. But thank you very much. That was brilliant. Next week is our final Walk in My Shoes before we take a break for the summer, and we will be discussing the role of the intermediary there. So have a great week, everybody, and I'll see you next week. Bye.
Thank you. Bye.